Welcome to the Broken Pie Chart Podcast, episode 335. I'm your host, Derek Moore. With me is Mike Snyder, our trading director at Zega Investments. What's going on, Mike? Welcome.
Not too much. Thanks for having me. How are
Yeah,
you?
I'm doing well. We were just, we had a group down in Arizona, and I was thinking about, explaining implied volatility, or I don't know, the temperature was definitely not high when you were here relative
Right.
to it was. Imagine a chart of implied volatility on a stock and you have this dip. That's what the temperature was in Arizona when you were here. It was pretty balmy for July.
Caught the lows.
You caught the lows. All right, so speaking of lows or highs, we got to talk about Opendoor, OPEN. I I mean, I don't know anything about the fundamentals of the stock. I know basically they were one of those companies. I think they came public as a SPAC, and then their whole business model is they go in. If you want to sell your house, you can sell it to them, and then they fix it up or do whatever, and they resell it. So basically, they're just hoping to do a quick flip and make money. And I guess they lose money if their capital is tied up and they're paying interest, and they can't sell their inventory, or they buy it and they sell it for less. Anyway, it doesn't matter. What matters is this is a meme stock. This is on the Wall Street Bets. It's on the chat forums. So, Mike, the part of the reason why people are saying this is all of a sudden run, although I would surmise it's more buyers than sellers, is that the short interest ratio went from, I don't know, around 12 in March, and kind of started creeping up towards the end of March, crested, let's see, kind of that June area. And it's come down a little bit, but recently it was 21.81. I think there's a couple week lag on this data, but the stock went from, I don't know, 55, 60 cents all the way up to above 3. So my first question to you is, who the heck is shorting a stock when it's 60 cents? Who is doing that?
Yeah. I mean, is it someone who really thinks that the stock's going to zero and is risking unlimited loss? I would think probably not. Although there may be some of those out there. There may be an institution with some sort of mandate looking at a stock under a dollar, thinking this is something we should short, thinking it could be delisted. Most likely, my take is that it's market makers that have other positions on that are hedging by shorting.
So let's think about that. So you're a market maker. I'll make you the market maker. I buy a put. And again, why am I buying a put on a 50-cent stock? I have no idea. But I'm going to buy a put. And basically, what does that mean? I make money if let's say it goes to zero. I get to sell the right to sell my stock at the strike price. You, as the market maker, are selling me the put. So now, what's your risk, and why are you going to hedge, and how are you going to hedge?
Yeah, I now have a bullish position. So the short put, you benefit when the stock stays where it is or goes higher from that premium you collect, and probably as a market maker don't want to be outright long this stock. So you're shorting the stock to help offset the risk of your short put, so that if the stock goes down, that impact of the short put is offset by the shares that you're short.
I still go back to, and maybe we need to do a public service announcement. What you said is really important, Mike, and that is, if you are shorting a stock at 60 cents, you have unlimited loss, meaning the stock could go to infinity. I've never had one of my stocks go to infinity, unfortunately, but you are short. The most you could make if you short a stock at 60 cents is it goes to zero. You have unlimited loss to the upside. So you're probably right. And I don't know why there was an increase from 12% of the float to 24% of the float. I don't believe they're doing buybacks and reducing their float. Although, again, I don't follow this stock. I have no clue. But I guess the other picture too is when we look at the implied volatility. So this stock, I mean, I know it doesn't seem like it's you look at the price, but to go from 60 cents to $3, that's kind of a big move. And the implied volatility, what the market makers and what the options market is forecasting for future volatility, has jumped up quite a bit. The reason why, when volatility increases, or when the perception is that a stock is going to really move, market makers are going to increase the prices for those options because it's priced in. Mike, I don't know if you saw this, but let's just look. I mean, when I pulled this, it was like 272, 273 in price. The $3 call had an implied volatility of 327%. Like, I mean, and I'm using the August 1st. So these are 8 days away. That's an annualized figure. That's kind of a lot, right?
Kind of, yeah.
So take us through that though. Like when we say 327% volatility, like what is it actually saying on a 1 day basis? It is actually pricing in being that high.
Um,
And by the way, I'll do the math for it. It's for the audience. You take 327 divided by the square root of 252, which is 15.875. It's kind of big.
yeah. So I mean, it's measuring a massive move for a stock at this level over a very short period of time. I mean, is the bottom line, and you can look at all the calls and their implied volatility here. It's all off the charts. I mean, you have calls as far as $9.50, the same expiration, trading over 11,000 times in a day. That's more than the open interest. That would be the stock more than tripling. Um, and those are even trading a significant amount. So
I mean, when you look at this, I mean, that's 21% is the one standard deviation move is what it's pricing in for 1 day. And then, of course, if you wanted to do out the 8 days, you would take the square root of 8 times, which is 2.83. Thank you, calculator, times 21. I mean, it's basically pricing in almost a 60% move over the next 8 days through the expiration. I mean, all right. So here's the other thing. Sometimes we call the covered call return, or some people call it the standstill annualized return. So please don't do this at home. But Mike, you know where I'm going with this. Let's
yeah,
say we wanted to sell. Let's take the $3 call. So the stock's trading at 273. We want to short the $3 call, and let's just pretend it's naked. Again, please don't do this at home. If I sell that for 44 cents, let's say 45 cents, and the stock just stays where it is, the annualized return on that is 878.5% annualized. Like that's how rich these premiums are right now, Mike.
right, right. And that is for a call that, I mean, on a $2.70 stock, it's $3 call, only 30 cents, but on a stock of this size, I mean, it's still, in comparison to a typical stock, a fairly big move. You could even sell a call that is at $6, for example, which is more than double where it's trading, and get an annualized return of 173%. So basically, what that's saying is if the stock doesn't more than double in the next week, you keep that premium. If you could do that every week, you're making 173% annualized. As Derek said, do not do this.
Do not seriously don't. Well, here's the other problem too. I mean, let's use the $6 one. You could sell it for maybe 10 cents, 12 cents. Let's use 10 cents. So what that means is if you're selling one call, you bring in $10, but you have unlimited risk to the upside. So to get $10, although on a percentage return, which is basically the time value, which is 10 cents here, or 12 cents is the midpoint, but we're using 10 cents divided by the price of the stock, and then you annualize that as if you were going to get it again and again and again. But I you mentioned earlier too, the open interest, and I'll for the audience, I'll give this here, 96.24 on the 9.5 call expiring 8/1 for Opendoor. Today, the volume 11,201, at least when I pulled this, and this was earlier. Just, I mean, do you think people are unwinding these? I mean, to put into context, I mean, it's 4 to 6 cents is the bid ask. Or are people buying these hoping to force a gamma squeeze or something?
My gut says people are buying them,
Could be right. I
but
mean,
it's hard to say. I mean, it's just, are people were people long these and they're now getting out at 3 cents? I don't know.
well, let's kind of break that down for a second because off sometimes people. Okay, so when we say gamma squeeze, it's become popular vernacular in the Wall Street bet forums and the Reddit forums, and it's this idea that by buying options, you can force a gamma squeeze, and that's very technical. But basically, they believe that, hey, if I buy a bunch of 9.5 call options, then the market makers have to, for every one of my contracts, they have to go out and buy 100 shares of stock. It's actually not 100 shares of stock. There's something called delta. And so, for example, the 9.5 call has a delta of 8% or 8 cents, let's call it. But it's a delta of 8. And what that means is for the next 1 point change in the stock price, keeping everything else equal, the implied volatility, everything else equal, if there's a $1 move in the stock, these options go up by 8 cents. And since you're doing one contract is equal to 100 shares, it's basically $8. So, Mike, if I'll make you the market maker again. If I'm buying one contract here, how many shares do you have to buy of stock? It's not 100, right?
No, it's 8
It's 8 shares. That's it.
for yeah, for now.
Well, tell me about that though. I mean, if the stock moves and the stock goes up, I mean, let's look at let's imagine the stock goes up $2 and we'll cheat a little bit and we'll look at the $7 one, or let's say it goes up by uh, $2.50. We'll look at the sevens. Fair enough. That's a good proxy.
Sure.
Okay. So what's the delta go to?
7.5. It's at 11.
So how many more shares do you have to buy?
3.
Yeah, and that's what can happen though. I mean, that's real. Where if there are a ton of contracts that are open, let's say open calls, and the stock starts to run up. As the stock starts to run up, the market makers, in theory, would have to buy back additional shares. We remember this in GameStop in 2020, and I think that was a legitimate thing that happened where stock went up. These calls that were basically worthless all of a sudden went in the money as the stock appreciated, and the market makers have to buy more and more shares. What you don't hear about too is that there's sort of this, like, if you're really doing this, you kind of have to know the exact moment it's going to stop going up, because you could have, and we'll talk about volatility in a second, but Mike, I mean, if the stock starts to come down, what does the market maker get to do with those shares they bought to hedge?
They get to they get to reduce them
They get to reduce them. That's right.
because your delta's going down, so they don't need to hold as many. And that could, just like on the upside, that can have the same or similar effect on the downside.
Yeah, I mean, it's sort of interesting. So, kind of wrap this up. I just it's you know we're not going to spend time talking about the intricacies of the Greeks, but Mike, I did pull just an example, and I said, what if we had an option on a stock $65, 30 days to expiration. The implied volatility is 17%. And let's say it's a $70 call. So $5 above the current price, 30 days left to expiration, 17% implied volatility, has an 8 delta. So just as Mike said, if I am buying that option, in theory, Mike's got to go and buy 8 shares of stock. But something that people don't understand is implied volatility is a big determinant of the delta. So if we raise the implied volatility, all else equal, same time frame, same stock pricing, everything else, goes to 50%, it's still 30 days to expiration, still $65. That's 70 call. The delta goes to 38, goes from 8 to 38.
Right.
So there's an example of nothing has changed. But now what has to happen as the market maker?
Yeah, you're going to need to short more shares,
Buy more shares, right? Because
buy more shares.
yes, because I bought the call. You're short the call as the market maker. You got to buy more
I'm
shares.
short the call. I have to buy more shares as the
Yeah.
delta goes up. That's right.
So if it happened just like that, imagine in an instant it just happened. You were long 8 shares to hedge. Now you got to be long 38 shares. And the reason why, because it goes up a point, delta's 38, the option increases 38 cents to hedge those 38. So, and let's say 15 days later, the stock's still there. The IV, the implied volatility is still 50, but it's 15 days later. Sorry, did I say 30? 15 days later. Well, now you have time decay. Nothing else has changed, and the delta goes to 25, meaning everything else stayed the same, but as time came off, the market makers could reduce. So
Right.
I kind of go through that, Mike, is just like this stuff is hard. And I I know people, I encourage people to learn options, and but when I see some of the stuff in the Reddit forums, it's tough sometimes. And this is a like you never know which of the inputs is going to change. So um I mean this is really difficult. And I know, you being in Chicago, you've been around people who've been on the floor, you've been around you've been trading options for a while. It's like you could get some things right, and if you get vol wrong, you might still lose money even if you got the right move, right?
Yeah, absolutely. It's more than just the right move. It's the timing, and it's the amount of the move, and it's what you're paying for the call. You have to factor that in. I mean, stock could go up 50%, and you could be long a call and you could still lose money on that call. So it's more than just stock direction that goes into this.
It's kind of like, I mean, we'll talk about, we'll save this for later, but it reminds me of the earnings play where, you buy a call or you buy a put or a straddle and you're like, oh, it's going to move a lot, but you could get the move, but if it's not enough or if vol gets crushed, you can still lose money. All right, let me talk about Goldman Sachs. Mike, can I make fun of some analysts for a while? Why not, right?
Yeah, go for it.
All right, Goldman Sachs, and I assume that Goldman Sachs knows more about I do and their chief economist because they're the chief economist for Goldman Sachs and I am not. But the reason why I say I want to not make fun of them, pick on them a little bit, is the way that analysts move their targets around. So this was from FactSet Goldman Sachs. Somebody had put this out on Twitter, and it was Goldman Sachs S&P year-end targets. So at the beginning of the year, their year-end target was 6,500. Okay, not bad. And the market's around 63 something now. It's, another 250 or so points, I think is the, yeah, right around there. But what happens? The market starts to go down in end of March or April, actually. And then they lower their target to 6,200. So the market goes down, so they lower the target. And then the market went down a little more, came back up, went down again. They lower it to 5,700. Then the market goes down again. I mean, the market was down at 4,900, starts to recover. And what happens? Well, when the market was, I don't know, above 5,700, 5,800, they raised it to 6,100. Mike, they've raised it again now. Now that the market's all the way back to 6,600. So now they're 100 points higher. Like, this isn't helpful. If all you're going to do is just move the targets around, if the market goes down, you're like, oh, I'm going to lower it. And the market goes up, you raise it. Like, what use is this for individual investors?
Yeah, I mean, I think it's proof that forecasting is difficult. And if anyone can tell you they know exactly where the market's going to go, show them the Goldman Sachs estimates and say Goldman Sachs has changed it multiple times already and has really just been more of a lagging indicator than anything forward looking. Um, yeah, not a whole lot to take away from it. I mean, there's the risks that you know, and then there's the unknowns that can come into play. And forecasting those unknown risks is, I mean, it's impossible.
When I look at this too, and to be fair to Goldman, look, they're really good over there. They're really smart. They've got great analysts. The chief economist is it Costigan? Not Costigan. It'll come to me later. Put out some good research. They all did this. If we had all the investment banks, they kind of all did this. I mean, for the most part. But I always say, and you'll be involved in when we make our predictions for 2026. We do a show at the end of December, and I always tell people, like, let's say that instead of everyone does the year end predictions and they look and see, oh, what will the market be at the end of next year? But if you look, I mean, imagine a year ago, you and I had to make predictions on where the S&P would be. And, to come up with a 63, 63, 35, which is where it is right now. I mean, you would have basically have had to say, you you believe the forward earnings estimate is 271.65. Why do I say that? Because that's the forward 12-month estimate. And to get this number right, you would have to say we would be at a forward PE at 23.46. I mean, Mike, you could have gotten the earnings exactly spot on. But if you said a PE of 20, nope,
Right?
you wouldn't be
That's all
right.
it takes. Yep.
I mean, that's why this is so ridiculous, these predictions. I don't think they're helpful. And it's just funny. Like if the market goes down, you're just gonna lower them, and the market goes up, you're gonna I mean, I don't know. All right. This goes along with let's see. Why are stocks up? Nobody knows. This was something that was passed around. It was an article in the Wall Street Journal, and the subheadline was, "A torrent of bad news hasn't been enough to sink the market." In fairness, I don't think most people read this article. And when I read the article, it's a callback to an Atlantic piece from, it might have been from the 90s, where everyone always tries to explain why stocks were up or down for the day. And they kind of made light of it, like, oh, is Peruvian gold prices or is this or that? But it goes back, Mike, to your thought of this is really tough. And I mean, don't you feel like this is a hated bull market still? Like, I feel like people are still on the sidelines, still hating the fact that stocks are up.
Yeah, it sure seems hated, and the more hated it becomes, the more bullish it makes me want to be. Actually, and I think that's part of why stocks are up is because this is a hated rally and there's money on the sidelines. There's powder that can be used to make this rally continue for some time. I think.
Have you ever seen the chart? We were talking about this this week when you guys were here. There's sort of that when forward PE is the scatter, the regression chart, where you have it's definitely downward sloping in a 5 or a 10 year period. The higher the forward PE, generally, the lower the annualized return is going out further, which implies there's some correction in the market and also kind of makes the case for being hedged. But we were talking too, Mike. I mean, over a 1 year period, the forward PE ratio is kind of useless to
Yeah.
predicting markets.
Yeah. Yeah. I would agree. Stocks can grow into those earnings, and so saying it's too high or too low, you know, I think markets can continue to run even as they seem overvalued in the moment.
We got some data too. I don't know if you saw this. There was some. What am I reading here? Oh yeah, S&P performance after it spent 60 days above the 20-day moving average since 1950, and this was from uh, who sent this out? It's Carson, Ryan Dietrich. There you go. And the title of it was "Yet Another Clue: The Bulls Should Continue to Have Fun." And what this looked at is other periods where it was above the 20-day moving average for 60 days. The last time it happened was April of 1998. It started, or I think it happened 721. We might still be above that 20-day moving average. So the period continues. You look at these, and all but 1965, the market was pretty healthy 12 months later. In 1998, it was 20.2, 97, 26.4, 86, 19.7. And what's interesting about that 86, you know, that was prior to the 87 crash, although that does not include it. So I don't know. I mean, do you think this is kind of one of those once markets are in motion, they stay in motion deals?
Yeah, I think it's a good indicator of momentum. Um, it's a good indicator of resiliency. Pullbacks have proved to be over the last 60 days to be buying opportunities, and especially recently. And I think we're going to get into this in a little bit, but the breadth has seemed to widen in this market, which I think is another sort of indicator of the potential strength and resiliency that we've seen here.
I'm trying to think what would be a case where the market. So kind of put this in perspective, a moving average, it's just what is the moving average over the last 20 days? Or if you're doing weeks, it's 20 weeks. If you're doing months, 20 months. And there's 20-day, 50-day, 100-day, 200-day. 200-day and 50 are kind of some of the big ones that you hear about. I mean, when you have trends are more often than not, they stay in place until they end. But it was funny because when this got brought up, Shane, who was on the show last week, I think he brought it up, and I instinctively said, I think it was 98. And I didn't see this yet. But 98, there's been some comparison because 98, we had the Asian contagion, foreign markets sort of had some troubles with the devaluation of some of the currencies, long-term capital management. But you had that extra surge from 98 to really to March of 2000 where the markets continued and valuation stayed higher. So I don't know. I don't know what we do with this. I mean, that's why we buy and hedge. It's like we don't try and time the markets, be long the market, have some downside protection. And especially for people who are in that final 10 years to retirement, near retirement, in retirement, it's like the reason why you hedge is you may not need to beat the market anymore, but you don't want to take a significant fall in your valuation, because what that means is then you're taking a cut to your lifestyle. Your what you can actually afford in retirement gets cut. But if you want any information on that, derek.moore at zegainvestments.com. That's derek.moore at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to spell correctly if you want to reach me. I don't know. Anything else from this? I mean,
Yeah, it's interesting. I mean, at the end of the day, it's sort of one of those indicators that's right until it's not. All these periods are so different where this has happened, spread out over many different years. Um, yeah, I mean, there's a lot of stats that the market generally goes up. So there's going to be a lot of statistics out there that show the market being higher in 12 months after a certain event, right? So I don't put a lot into it, but it's certainly interesting. It hasn't happened a lot, which is why I think it is interesting.
you mentioned the breadth. Let's go there first on our list. And I'll set this up for everyone, for the listeners. We're looking at a scatter plot, and it's S&P price return versus breadth since 1996. And July 22nd, 2025, it was a good day. There was breadth in the markets, and I'll ask you in a second to sort of explain that. But the setup on this graph is no other day with that good of market breadth had a smaller gain. It was pretty much unchanged that day. So kind of explain what market breadth is. Like, why do people care about it? Why does it matter?
Yeah, it shows really how deep the gains were that day in terms of, was it a few stocks that were driving the return? Was it many stocks that were doing well that were driving the return? And so I think it goes to how how deep this rally really is. Is it a handful of stocks that are driving everything, or are a lot of individual companies viewed as strong and doing well right now? And I think the wider the breadth, the stronger the rally may seem.
So, was there anything on the day in particular? Like, why was the market flat with that good a breath? I mean, it's an outlier when you look at this. Did you
Yeah, I
find anything?
mean, so a lot of the mega tech names were down that day, which is interesting. So I mean, when you think about a lot of stocks being up, but the return being close to flat, it's okay. Well, were all the stocks just up a little bit, or was it that there were larger weighted stocks that were down? So a few stocks that are larger weighted in the S&P that may have been down, but still the majority of stocks were up that day. And so they sort of offset each other. You had more stocks that were up, but the stocks that were down were larger weighted. So you had a stock like Nvidia, which now is 8% of the S&P. It's the largest any individual stock has ever been in terms of the concentration in the S&P 500. Was down
Really?
was down 2.5%.
Wow.
So
Okay, so that's kind of a big deal with that big of a weight, down 2.5% when there was great breadth. So yeah, that's what it was, right?
right.
That's a big deal though. 8%. Like, how do you feel about that? One company being 8% of the S and P.
Not, I mean, not great when you think that you have something really diversified, and it's diversified, but that's a big chunk um, for the index. I mean, you own a lot more Nvidia probably than you realize when you're buying the S&P 500.
Doesn't everybody just want to own Nvidia though? Like, that's kind of cool. You're getting more of the if it keeps going up, that's great, right?
It keeps going up. It's great.
But all right, so let's kind of pause on this for a second. Like, I know people get hung up on the weighting in the S&P and the members of the S&P, but Nvidia wasn't in the top 10. Certainly wasn't the number one company. I mean, 10 years ago, I don't even know where it ranked. Like, this my point is, this index definitely reconfigures itself. And although Microsoft has been in the top 10 for years and years, Apple wasn't always in the top 10. So, it's the biggest company today, but um, I don't know. Yeah, maybe the other ones catch up. It doesn't have to necessarily fall if the other ones just catch up or exceed it. I mean, don't you think?
Yeah, I mean, not too long ago, ExxonMobil was one of the largest weights in the S&P 500, and it's no longer in the top 10. So, and it doesn't necessarily mean that ExxonMobil, went down in price, but it underperformed relative to some of these mega tech names. So there's constantly, and it takes time, but you would think that over time other companies would catch up and help balance that out.
I'm trying to do it from memory, and I was curious: is there a cap on how big a stock can be weighted? I think some of the other indices or indexes they actually have some sort of a rule, and they would have to bring down the holdings of it. Do you know if there's one?
I don't. That's a good question.
I'm looking here. I guess I could ask. Could I ask ChatGPT? All right, let me come back to that. Yeah, I mean, I don't know. I mean, look, you're less. I agree. You're less diversified, but the S and P has always been more of a momentum index, meaning you're buying more of the stuff that's going up and you're selling some of the stuff that's going down. So, and it is a little bit actively managed. I mean, Hess, the merger goes through. They bring in. I think they brought in Square, but they're making active decisions about companies they kick out and they bring others in. I've always said that it's a bigger deal than people realize because sometimes you bring in companies that are growing their earnings or have more earnings and you're getting rid of the ones. it all aggregates to the same place when you deal with the earnings per share. But um, all right, anything else on that?
Yeah, I mean, to your point, it allows you to capture momentum, right? Because it's not going to naturally rebalance so that everything's weighted equally. So we know that when stocks run and make new all-time highs, a lot of times they continue to make new all-time highs, and so it does allow you to capture that sort of momentum in these mega cap companies that have continued to make all-time highs because it doesn't rebalance it into an equal weighting.
I feel like I won a gentleman's bet with Jay. I think I said Nvidia would be the highest weighted company at some point. I think I did. And I only talk about the ones that I win. I never talk
Right.
about the ones that I lose. So I'll have to ask Jay that. Something to going to the breath for a while. It was really, as I think you mentioned, it was those big mega cap tech companies that were driving all of the returns. So I did pull up since the low in April, which was 4.7. The S&P index is up 26.17% total return. The RSP, which is an ETF, which is an equal weighted S&P ETF, up 20.35. So, I mean, that's pretty good, I think.
It's tighter
Uh,
than I would have thought.
yeah, like it's definitely broadening out, and I feel like it was broadening out even before the April sell off, which was kind of a shame when that happened because I mean some of the other areas were definitely coming back. Um, I don't know. I mean, I guess the bull case is you need that extra participation. Um, I don't know. So let me ask you this, Mike: is the market going to 7,000 by the end of the year?
I wish I had that answer.
I'm going to say yes. Why not? I
Yeah,
think
I mean, it's certainly in the realm of possibility.
I like that couched answer. It's
Yeah,
it's
I knew you would.
no, I mean it. Nothing would surprise me. So what is 7,000 from here?
10
7,000.
percent. It's 10%.
Okay. So we just looked at that 20-day moving average thing, right? Well, actually, we looked at the figures from a year. So yeah, I mean, another 10% isn't unheard of. What would have to happen? Do you think it's earnings, right? And guidance, like we'd have to see earnings estimates be raised, right?
I think so. Yes.
And that just goes to let's assume we keep the same multiple, but the earnings estimates rise. I mean that's kind of how you do it, I think. But
Right.
look, I don't know. That's why that's why we buy and hedge, right? Like seriously,
Exactly.
I don't know. You should listen to everyone should go back and listen to our predictions from like December, and you'll see how wrong we were on stuff. And that's all of us we look at this stuff and we're fans of the markets and we're very tuned into it. But when you run investment strategies, you're sort of you're not making decisions based upon where you think the market is. You put a structure in place. We hedge. We do have a strategy called the Four Seasons, which we actually bring in 19 different volatility based triggers to sort of have four different postures, some bullish, some bearish. I mean that's we're actually doing some of that there. But okay, let me go back to get us on track. Um, who is it? Liz Ann Saunders from Schwab tweeted out a Bloomberg chart, and it's basically saying there are two possible dissents when the Fed meets. I think that's July 30th. That's next week. When the Fed meets, two FOMC members are going to vote against or probably vote for a cut when everybody else does not. And I think she tweeted this out because if we got two dissents, it would be the first time since 1993 when that's happened. Um, I don't know what to do with this, Mike. Like, is this anything?
You know, obviously there's not an expected cut here in July. I think there's what I've read recently, 60% chance in September. So is this just two governors sort of getting ahead of that? Is this political pressure, do you think? Could it be?
Oh, they could be auditioning, maybe.
Yeah,
Trump definitely wants cuts, so maybe this is the way to say, "Hey, I'm the one. Make me Fed chair.
right.
I'm all for cuts." Yeah, I don't know. It's the audience can't see this chart, but you look at the 1980s. I mean, a lot of times there were two dissents, three at times, and then in the 1960s, I mean, this goes back to 1936. The highest, I don't know what meeting this was, probably late 50s or so, four dissents. So, all right. I mean, look, the chair usually gets what he or she wants. And this is all sort of discussed, I think, prior to it. But I don't know. I, let's move on. Nothing else here. All right. I know you wanted to talk about this. I said this is silly, but you wanted to bring it in. The monthly breakdown of S&P 500 all-time highs. This was an all-star chart tweet. And this is by month, which months have the highest number of all-time highs? Mike, take us through this.
Yeah, let me explain exactly how this works. So,
Okay.
no, I mean, I guess you can sort of tell yourself a story because of the times of the year and maybe where institutional money is flowing. January, there's new money coming in at the start of the year, so naturally there's likely more buying. That seems to be a month where there's more all-time highs made than sort of the average. I think that's what third most is January. The most is in November, which is pretty interesting. I thought maybe it would be December, but November, it could be fund managers trying to catch up, and rotating more into equities and putting more risk on when they're looking at performance. Just a thought. I don't know. What do you see here?
Yeah, I mean, often when a market is very strong, it runs throughout the year and then kind of makes that. I would have expected more all-time highs towards the end of it, but July, yeah, I mean, why not? It kind of I I can't really read anything to this. I mean, August, September. What is it? August is sometimes one of the worst months, although you have some outliers in there that drag that down. Um, yeah, I mean, here's the thing that you don't see. It's not like everything is January and everything is February, and it's pretty spread out, to be honest with you. And as you said, Mike, markets go up more often than not. So there you have it. But July has been a good month. Only dwarfed by January and November, right? January, November. Yeah,
Just
by
November.
November, just
Yeah.
November. Yeah. Well, staying with the kind of the bull market theme, somebody had put this out. I don't know who put this out, so I'm sorry, I'm not giving them credit. But this bull market they have starting December 10th of 22. As of the time they grabbed this, it was 694 days, trading days, and the cumulative percent change was 76.4. So I think their point, Mike, was what? That 694 is below the average of 1146 days since 1950 in bull markets and below the median of 978. I think what they were trying to get at is what? That the market still has more to go, right?
Yeah, I think that's the case for this hasn't been a bull market for that long, and the return, you know, hasn't even hit its median when you look at past bull markets. Percent return 76.4%. When you look at the median bull market, it's 91.3%. So if you're looking for conviction to get into the market, this is a chart to look at, to tell yourself that bull markets can last a lot longer than this one has lasted.
I'm looking through these days and let's see. Yeah, so I'm looking at the 2008 one. That almost doesn't look right. So it's weird. It's like 20/11. That would almost be 11/20 of 2008 to 6/1 of 2009, 24.2%. I'd have to look at that. I feel like that doesn't make sense because the low was March of 2009, right?
Right.
Unless,
Was there so November 20th to January 6th, a 30-day bull market before that?
yeah, it doesn't seem right. That does not seem right. Well, because you see the other one, the 9/3 of 2009. So in Europe, maybe this is a European firm who did these, but
Oh,
if you
right.
flip it, yeah, it'd be 3/9 of 2009. Okay, so that makes sense. That's probably the low. And then to 2/19 of 2020, which makes sense because that was the start of the COVID crash. 2,756 days, 400% cumulative change. Okay, that makes sense. I don't get the other one, like why that's even on there. I guess it was a bear market rally in a
Right.
cyclical bear market. I don't know. So yeah,
But
if good.
no, that's what I imagine it was. It was just a little bull market inside of a bigger bear market.
I will tell you too, and I remember this throughout. We bottomed, the famous Mark Haynes bottom in March of '09 when Mark Haynes, legendary CNBC on air talent, said, and I think the market was 666 at the time. He's like, "This is it. I'm calling the bottom," and that wound up being the bottom. But all throughout that recovery, it was a hated bull market as well. Like I remember people in 2010 saying, "No way this lasts. This is just a bear market rally, like we were just talking about." And it kept going. 2013, no way this can continue. And I can't tell you how many people stayed in cash for years after that. And I also remember, when my first year was 94 in the markets, and people had that memory of 87, even though the market was up that year or flat for the whole year. Like these are instances where it's a hated bull market. And if you are an investor, it's like you almost want people to hate the market. It's because that means there's more, like you said, there's more money on the sidelines. So, all right. I did, according to ChatGPT, Mike, I asked about constituent weighting, and let's see. It says the index isn't. What does it say? Whatever. However, this isn't unlimited. Okay, it doesn't even make sense how it said that. But there's a diversification rule, 10% cap for funds. So while the index itself doesn't impose a strict cap on any one stock's weight, index funds and ETFs tracking the 500 S&P 500 often comply with Regulation 5/10
Mm,
40, particularly in the U.S. or under U.S. mutual fund rules. No single stock can exceed 10% of a portfolio's value, and the sum of all the positions above 5% can't exceed 40% of the fund. That's
interesting.
interesting. Yeah. So is what I'll have to do more research, but you know how I do these. It's we don't cut anything. We don't, we just kind of keep rolling. So I'm doing this on the fly. We'll have to research this a little more, but I wonder if there's an instance where imagine Nvidia goes to 12% and they can only hold 10. So some of those index ETFs would diverge from the index itself. Okay, we'll come back on that, Mike.
Sure.
I don't know what the rule of that. That would be interesting. And it would actually create a little bit of an arbitrage because you could replicate the S&P 500 index using options, and then you could short or go long the other. All right,
That's
we'll
right.
we'll we'll come back to that though. Last thing was real estate, and then we'll get to our recommendations. Existing one-family home sales median price, NSA, national. I think that's national sales average. I think that's what NSA stands for. Year over year, percent change 1.99%. Okay, why am I talking about this? I think people are very focused on the number of transactions. They are, the turnover, so the number of existing home sales, that's been lower. Mortgage demand, that's been lower. No surprise there, especially because nobody's refining. But I think the reason why I put this in, Mike, was like housing is still staying up. I mean, it's still gaining. 1.99 is it's not nothing. It's below inflation, but still, I mean, I don't know. Do you read anything into this besides it's not bad news?
Yeah, I mean, it's stable, and sort of like you said, the major headline is interest rates are high, and no one's buying houses. Well, I think there's probably less people, like you said, buying houses. Mortgage applications are down, but there's also that's weighted with less inventory. So it's housing prices are stable. I think there's people that probably want to move, and aren't because of their current interest rate, and they're just expanding their house that way. Maybe when we see rates drop, sure, you get more buyers, but I would expect also inventory to pick up. So
Yeah, that's the thing. I mean, if the number of transactions might be irrelevant if you own a home and are worried about the value of your home. Like honestly, you don't want inventory out there because
right.
yeah, it's simple supply and demand. So I think one or two people who are moving, right, or getting a house. I think you're actually familiar with that situation. So
Yeah, I've heard some people are moving this weekend in 2 days.
Uh, all right. Well, last thing, and then we'll get to recommendations. I lied. So, Microsoft, Apple, Amazon. It's going to be a big week for earnings. I think Google earnings were solid. Tesla was down, but the call wasn't horrible. So, I'm looking at the Microsoft options expiring next Friday, August 1st. Stock closed at 510.88. Let's see. Let me do the. Is there a 511? No, they're going to have 5 or 10 point wide strikes. So five, let's use the 512.5. So the implied volatility is about 34 and a half. So what is that? It's the 1 day expected move of 2.2% right now. That's,
Right.
I would, I mean, I think implied volatility probably rises as we get closer to the event. I think it's either next Wednesday or Thursday. But that sort of seems low to me, doesn't it?
It does seem a little low.
Why is
Yeah.
that? I mean, it's a high price stock too. That's interesting. Let's look at
Yeah,
Apple.
like
Yeah,
the
go ahead.
at the monies are, the 512 and a half calls are trading at like 10:30, and the 512 and a half puts are like 11:30. So I don't know, just make it easy. Call it $21. I'm doing this on the fly.
Hmm.
Yeah, it's not a huge move. It's what, like 4% move.
Yeah,
It's smaller than I would have thought.
Apple, by the way, is kind of the same 36.8. Call it 36, 37 ish. So same boat. What's the other one? Amazon. All right, look at Amazon real quick. And Amazon. I mean, in fairness, we'd sort of want to look at this the day before earnings to get a true gauge of what the market is pricing in for the next day. But
Sure,
we're still 8 days out. Amazon's 232. Let me look at the money. All right,
a little more.
22.6. What do you see on that? Am I looking at the right one?
Uh,
232.50s. I see 22.60 for the implied volatility. What do you have? Oh, that's July. I'm looking at the wrong one.
yeah,
Yeah, yeah. Well, all right. So that's in. So the July's expire tomorrow, and there's no earnings tomorrow. So the volatility is lower, and that's a good example of where the earnings are not in tomorrow's expiration. So then you look at tomorrow's expiration. Yeah, that 232 and a half. Okay. Yeah, what'd you say it was? 47, 48, right there?
yeah. Yeah, right there, 47.
All right. Well, we'll take a look next week. I think between this week and then next week, like a lot is going to be known. I think the bulk of the large cap mega techs are reporting. So we'll see what happens. All right, Mike. So I've stolen this from Barry Ritholtz and his Bloomberg podcast. Was it Market Masters? I think is the name of his show. He would always ask his guests, like, "What are you reading, watching, writing?" So we usually do a little bit of recommendations for the audience. So anything, I know you just had some travel, you probably watched some stuff on the plane or whatever. Anything to recommend to the audience?
Yeah, we just finished The Bear, oddly named enough.
Great.
Yeah, takes place in Chicago, so had to make sure that I watched that one. Great acting. Not I turn it off, and every time I'm like, I feel like I'm more stressed than before.
Yeah.
These people have so much going on, but the acting in it is great, and the way it's shot is great, and um, yeah, highly recommend.
So that was season 4 that just ended, right?
Right.
I've read they're gonna do a season 5. The question though is all the actors in that show have gotten bigger since they started. So trying to wrangle everybody together when they can all shoot will be the challenge. But I've heard it's going to come back for season 5, which would be great because I feel like, without giving a spoiler,
It needs
it
to.
it needs to, yeah, to resolve some
Yeah.
things for sure. Do you season 2, the Christmas episode was the most
Um,
frenetic. I mean, it went for an hour and 20 minutes, but just crazy the acting in that. I mean, it was just nuts.
yeah, I broke that one up into multiple nights. I got halfway through that and needed a break. It was, but incredible.
Yeah, and Jamie Lee Curtis is in that, and she
Very
is
good.
just so frenetic. I mean,
Yeah.
just yeah, that was my favorite one. Was it was Richie's? What they call it, spoons, where he goes to the restaurant. I
Oh
won't
yeah.
ruin it for the yeah. That's probably my favorite one, but the best acted one was the Christmas one. So all right, I watched on Netflix a show called Untamed, and I like it. It's not a movie. I always like the movies better because sometimes you don't want to commit to a show. But it is a limited series about a federal agent, and I think it's Yosemite Park. So he's kind of like a park ranger-ish federal agent, and it's 6 episodes. So I'm in episode 5 so far. It's pretty good. So I'd recommend that for the audience. I'm giving it a strong buy recommendation. It's on my conviction list, Mike. So
Great.
all right.
I almost started that one. Is that Eric Bana and Sam Neill?
Yes, I
Okay.
believe so. Yeah. Yeah. It's worth it. It's good. It's good. It's not yeah, like I've been trying to get my wife to watch Breaking Bad, and she looks and she's like, "Oh my god, it's like 20 episodes a year. There's like 7 or 8 seasons." She's like, "I just can't do it." So six episodes on Netflix. I think you're good, and it's
Yeah.
limited series, which means it's not coming back. So highly recommended. All right, that's it, Mike. You did it. We got to the end of the show. So good work. Thanks to everyone for listening. Send those emails, derek.moore at zegainvestments.com. We like getting audience emails and questions. And we'll see everyone next week. Thanks, Mike.
Take care. Bye bye.